Good morning. I'm David Adams. Hope you're enjoying the beginnings of spring 2012. I'm here to give my brief thoughts about the direction of the economy and the markets, mainly as it relates to quarter two of 2012. A couple of quick points. Housing is still slow and well below the trend of, put that in perspective, 1.5 million is the average for annual housing starts, and we're currently at around 700,000. That's as of March. Unemployment is slowly coming down. It's got a long way to go back to the 4 to 5% pre-recession levels. So it's going to be a slow process for both housing and unemployment. I hate to be Debbie Downer, but it took about 20 years to build this asset bubble, and it's likely going to take at least a decade, in my opinion, to get some sort of asset stabilization. Also, when companies laid off thousands of workers, they're now finally seeing those record profits and realizing, maybe we didn't need all of those workers to begin with. So no way are they going to go back and replace all of those positions. It's going to be a slow process to add back those jobs, slow to hire, quick to fire, we all may have heard. Don't get me wrong, I think there are jobs out there, but you're really going to have to scrap and fight pretty hard to get a good one. It's competitive, and the scales are definitely in favor of the employer and not the employee. I had an interesting, I'll call it a privilege, to have lunch and dinner with a well-known economist, Dr. Bob Froelich, Chief Investment Strategist for the Hartford. He and I talked really about his 10 investment themes for 2012. And I asked him, Dr. Bob, and asked him this point blank, do you think the U.S. is going back into a double-dip recession, really facing the headwinds of China and Europe, and then the debt-ridden economy that we've put ourselves in? His opinion was a very confident no. So logically, as any of you, my clients would ask, I said, why and how in the world not? And his answer was really based on three big assumptions that go directly against what we're hearing every day in the media. The first one of those assumptions was Europe, that Europe is not going into a recession because there's an easy solution. If you simply lower the interest rates like we did ours and devalue the currency, German exports increase, and in that scenario, it's almost impossible, according to Dr. Bob, to have a recession. And really, that's because Germany is the second in the world, only to China, as far as exports go. In fact, according to Wellington Management, they do over $1 trillion of export goods and services a year. The second reason that Dr. Bob explained to me that he doesn't think we're going into a double dip is that China is likely to not have a hard landing. So maybe they go from a 9% GDP to a 7% growth rate. That's just not a big deal. In fact, they may lower their interest rates and get back to that trend 9% growth rate. Also, keep in mind that other emerging markets typically follow China. So if that's the case, then we could see global stocks really get some momentum. Reason number three, the U.S. is probably still going to just muddle through this mess. The trend growth rate of 3% may be cut down to 2%. But as I mentioned earlier, the two biggest headwinds are really unemployment and housing for the U.S. But at a 2% growth rate, the stock market really still has the potential to grow, and that's not a horrible thing at that growth rate. Okay, David, so based on all of this, what do we do? Well, I asked Dr. Bob what his best investment ideas were for 2012, and his number one conviction was very parallel to what I've been writing about in my newsletters on my website to all of you, my clients, for the past 2 years, and that's dividend-paying stocks. Okay, why dividends? If, in fact, the U.S. is going to muddle through with slow growth, you could have the potential to buy companies that can, or where you can get even a third to even half of your expected growth just on dividends alone, as opposed to just getting it through capital gains and appreciation. That's a great start, in my opinion. Additionally, we all know that corporate America is flush with cash and that they're not hiring, M&A activity is low, and the capital expenditures aren't back where they were or where they should be in this type of a strong economy. Therefore, it's very unlikely, or it's likely actually, that companies are going to continue to increase their dividends. And also with the nervous retail investor, as things slowly get better, you're probably going to see investors ready to dip their toes back into the stock market. And when they do, it's probably going to be the bluest of the blue chip companies with those high dividends. Now, you all know that I typically avoid the masses when making investment recommendations, but this time it so happens that the average investor of the masses may put their money in a place where it makes sense to me this time. This may not be a long-term play, but I definitely think it's a good one for the near future. Okay, so what about bonds? There's no questions bonds have had one of the biggest bull market rallies, arguably in over the last 30 years. But let's look at the basics. When interest rates go down, bond prices usually go up. The U.S. has been lowering interest rates and therefore giving bonds a backdrop for great returns. But we're now near zero. They cannot go anywhere but up. And that's not my opinion, folks. That is a fact. It's just a matter of when. Rates go up, bond prices usually go down. Okay. So then where would you want to put some, or at least the majority, of your bond portfolio? I'd say for suitable investors, you really need to look at global bonds. There are over 40 countries that are beginning a global easing cycle in lowering interest rates, which provides a great landscape for their bonds. If you're buying domestic bonds, I think you focus on shorter durations. So when interest rates go up, you're nimble and you have the ability to reinvest at those higher rates. Look, I get that it's unlikely for anyone, nor would I ever advise anyone to be 100% in the stock market, even when fundamentals suggest equities over bonds. We should all own some bonds, in my opinion. Why? Simple, because our appetite for risk cannot handle owning all stocks and taking the risk that there may be a global event that shocks the markets and causes a significant drop in value, like 2008. So you may want to consider owning a healthy dose of good quality companies, balance that with some bonds, emphasize the right types of bonds based on the current conditions, and then maybe consider some alternative investments. And we can discuss that later. That's an entire topic or conversation. But all of these things to help further reduce that volatility. In my opinion, this is a strategy to win long-term in the market. Okay, that's it for my thoughts on the direction of the markets and the economy for 2012. I'm David Adams, not Seth Meyers. For those of you jokester clients, you're going to find that funny. Of course you do. But remember, there are more important things in life than money. Focus on the things that you can control, like having a long-term wealth roadmap and making decisions based not on emotions. And don't focus on the things that you cannot control, like the stock market. I'll see you next quarter. Oh, I realized I didn't even mention the elections. I have to save some excitement for my next market update, so stay tuned.